Well, good morning, everybody, and thank you for joining us here today at our session entitled Finding Investors Who, Where and Why. My name is Chris Collett. I am part of the corporate solutions business at NASDAQ OMX. This is our first day as part of NASDAQ OMX. I know that it's branded Thomson Reuters, but we have been Thomson Reuters up until just a few hours ago, but very pleased to say that our corporate solutions business has now transferred over to our new owners. Just a few quick words by way of background. I spent around 10 years as a sell-side analyst covering the media sector before moving into investor relations for Reuters and then Thomson Reuters before taking up my current role in the corporate solutions business, helping companies with identifying their shareholders and finding new prospective investors. And I'm joined today by a former colleague of mine, James Fitzsimmons.
Good morning, everybody. Thank you very much for coming to this hour session. You, I think, managed to successfully tick the box of where. This is quite a far away from everything else going on out there, so well done for getting here. Thank you very much. As Chris mentioned, my name is James Fitzsimmons. I head up the corporate access team in the EMEA region out of London, and I've been with Goldman for about 14 years now in a variety of different roles. Part of it at that time was as a pan-European salesperson, but for quite some time now I've been working within the corporate access sphere, organising investor relations strategies for corporates such as many of you in this audience. I'm very much looking forward to talking to you a little bit today, and I'll be focusing on the US as it's our backyard. And I think for ease of this session, because of the size of the room, let's try and make this as interactive as possible. We don't want to be talking at you for the next hour and so minutes. So please, if anybody has any questions, don't hesitate to raise your hand and let us know, and we'll hopefully be able to answer them.
Great, thank you very much, James. Now let me come around here and let me stand over here and we'll get started. So, as James mentioned, we've got about an hour. We're not planning to talk through this PowerPoint for a whole of an hour, hopefully only for about 30 or 40 minutes. And as James mentioned, really we do want to make this as interactive as possible. If you have a question, please do put up your hand. If there's anything that isn't clear, then please let us know. Let me just start off by talking quickly covering what it is we're going to address today. The purpose of the session is really around investor targeting and working with different sources of information and different advisors in order to construct and execute the most successful targeting program that you can. And in order to achieve those ends, we've divided up the presentation into a number of different areas. We're going to start off by talking about the importance of setting objectives, and clearly a critical part of setting objectives is to understand your current shareholder base and how that benchmarks against your peers and where deficiencies or underweights or overweights in your shareholder base may exist, and therefore what you want to actually achieve by going out and conducting your targeting program over the months ahead. So we'll be looking at some benchmarking before we then look a little bit more at some of the top buyers of German stocks. We'll be focusing particularly on the US investors. As James said, that's really his backyard, so we thought we'd take a little bit of a deep dive into the US investors, and specifically the ones who are currently very focused on German equities, what it is that they're interested in, the sorts of questions that they're asking, the sorts of themes that they're focused on. And then we are going to go back to a little bit more benchmarking and actually look at some of the meeting data. How many meetings should you be conducting? How many one-on-ones? How many broker conferences and so forth? What roadshow destinations should you be going to before we then wrap it up. So let me just first of all just get started by a little bit of market context to the whole topic of investor targeting. What this slide shows is the fund flow from Thomson Reuters Lipper over the last year or so, and it's very well known, of course, that we've seen a real outflow of equities out of actively managed funds and into passive and ETFs. And what the chart shows is actually the fund flows for actively managed money. So stripping out all of the passive, stripping out the ETFs, just focusing on the actively managed pool of money. Of course, the addressable market, if you like, for investor relations and for this audience. And as I said, there's been no surprise. Everyone knows that there's been a long period of outflows, although a little bit of a spring at the start of 2013, where we've seen money starting to flow back into actively managed funds. So about 36 billion coming in so far this year, although very, very heavily focused in a burst of enthusiasm, if we like, at the beginning of the year, and then starting to taper off. So of course this has a real impact on investor relations officers and their programs. That of course, that, as I said, that pool of addressable money over time has been shrinking, despite this small blip at the beginning of this year. But then on top of that, there's been another trend which is influencing the overall market, and that of course has been the shift towards global money. So if we look at the amount of money that has been actually coming out of domestic funds, regionally focused funds, industry focused funds, money has been very, very steadily over the past many years coming out of those areas and going into global funds. Now, of course, the challenge there for investor relations officers is that that finding a fund that is focused on investing in Germany, or a fund which is focused on investing in the Eurozone, that pool of money is slowly shrinking over time. It is going more into global mandates or invest anywhere funds. That has a real challenge, of course, that you are therefore a very small part of a much larger fund. You have you have to fight to be heard, if you like, to actually get time in a global fund. And then one of the other trends that has been impacting the buy side, which I think is very relevant for investor relations, has been the extraordinary fee pressure which has come on actively managed money. So not only have they seen redemptions, very savage redemptions over the last couple of years, but there's extraordinary fee pressure on the money which they are actively managing. So therefore their ability to travel, their ability to hire staff and so forth has been coming down. And that really does mean that you're often talking to people who are themselves, their own business model is under real pressure, and their ability to get out and to come and see you is generally reduced, and therefore you need to go out and see them. One other thing I'll just add on here is that within these flows has been the trend towards dividend and income funds. So over the last quarter, so first quarter of 2013, we've seen about 8 billion flow into income funds and dividend funds, and that was a theme that we saw also during 2012. So not surprising in the current low rate environment, even if that is starting to tick up a little bit, that the hunt for yield is out there and that people are moving money into income funds. By contrast, that money has been coming out of growth funds. So we've seen about 7 billion coming out of growth funds over the same period. Again, another challenge. Good if you're paying a nice healthy dividend, but much more difficult if you're a growth stock on a low yield. So that is just a few words about the overall macro environment in which investor relations teams find themselves. So let's go now just into a little bit about benchmarks. Why we thought that this was an important place to start was when thinking about a investor relations targeting program, it's really critical to start off with what is the current makeup of my shareholder base, how does that compare against my peers in my sector, peers geographically, and what really are the objectives of my program. Is there some underweight or overweight on a geographic basis that we want to try to correct over the next little while? Of course, we know that in investor relations you're only ever an influencer, you can't make people buy, but at least it's good to have those objectives of what it is that you want to, the ways in which you want to influence your shareholder base. Similarly, are there ways in which you're overweight or underweight growth or value investors that you want to correct? Or is the holding period of your shareholder base generally too low? Your shareholders too short-termist? Do you want to correct that? Too many hedge funds and so forth. So we'll just take a look at some of these benchmarks. I should say that the data behind this is it's aggregated private shareholder data of German companies, both DAX and MDAX. We've taken a very large sample of our German company client base, aggregated it so that everyone's data is kept very, very confidential, and then created these benchmarks from it. So it gives you a much better benchmark than, for example, just using the publicly available data. So at the top slide, we see there is the geographic distribution of ownership in German companies. And you have is, if you take if you like, the Anglo-Saxon world, the US and the UK, together those two countries account for over half of the ownership in German companies. To give you an idea of a point of comparison, if we go over to France, that equivalent figure would be 45%. And then if we then look going down to the next bar, look at German institutions. German institutions themselves control 16% of German companies. Again, by way of comparison, if you go to France, that figure is much higher at 21%. So what that really points to, of course, is the quite thin depth of the German capital market, and therefore the need for German companies to really go out and find global investors, because the domestic market is simply not as robust as it is in other countries. And then, of course, if you go to other markets like the UK, that level of domestic ownership rises again. Looking then at the investment style, growth and value investors roughly even in terms of their ownership of German companies. Actually, interestingly, somewhat lower than the pan-European average, and hedge funds owning about 2% of German companies, but that is in line with the average that we see across Europe as a whole. Then going on to the all-important topic of turnover or investment horizon. You can see from this that what we classify as low turnover investors, that is investors with an average holding period of 2 years or more, own 79% of German companies. So actually slightly lower than the pan-European average. Of course, all companies want to find lots of long-term investors that will buy and hold their stock for many, many years. But interesting to note that sometimes that is not necessarily always a good thing, and that actually having a smattering of moderate and even high turnover investors can be a good thing, in that can really stimulate the trading activity in your shares, particularly when you're looking at some of the US investors where their compliance departments will be looking to make sure that any new investment meets a minimum turnover criteria. And if your shares aren't turning over sufficiently, particularly in the current low volume environment, then you can sometimes not meet their minimum requirements. The chart at the bottom shows the concentration of holdings. So in other words, just to read this chart, on average, the top 10 institutional holders of German stocks own 21% of the free float of the company. So we've stripped out the strategic holders, just looking at institutional holders. And that is really an incredibly diverse or diffuse number compared to the average. In other words, on average, German companies have a very diverse shareholder base. The average across Europe as a whole for that top 10 is around 40%, so a much greater level of concentration. So in other words, this is a very desirable characteristic, to have a very diverse shareholder base to protect you against volatility in the event of some of your top shareholders deciding to sell. Another way of looking at your shareholder base and then benchmarking it, of course, is to look at the proportion of the holdings that are coming from other types of investors, such as sovereign wealth funds, socially responsible investors, and mentioned before about hedge funds. Sovereign wealth funds, of course, we've all seen the trend towards increasing ownership by sovereign wealth funds. So behind this, we've got, of course, Norges, GIC, China Safe, Qatar was seen as a very particularly big buyer of German equities, to the point where now, on average, sovereign wealth funds own 10% of the institutional holdings of the average German company. And that is ahead of the European average, which sits at about 7%. Really not surprising, given that many German companies have the characteristics which sovereign wealth funds are looking for. That is, that they tend to be very high quality franchises, very global, tend to have good exposure to rapidly developing economies, good corporate governance and so forth. So, as I said, not surprising that we've seen sovereign wealth funds continuing to increase their positions. And given some of the recent trends, we would expect that figure to rise even higher in the future. Socially responsible investors, again, another area where, if looking at targeting for certain companies, it makes sense to, in certain instances, to really focus on socially responsible or ESG investors. The average across the German corporate base is 7%, according to our methodology and our criteria of what constitutes an SRI or ESG investor. Interestingly, that's actually slightly below the European average, which stands currently now at 9%, which we thought was unusual, given the emphasis that SRI and ESG is generally placed on by many German investor relations teams. So let me just go now to some of the top buyers of German equities. This is over the last 2 quarters. And before I hand over to James to talk a little bit more about some of the trends, particularly in the US market. So this is based again on private data, aggregated private data. So we feel it gives a pretty good snapshot of the institutions which are buying into German equities. Couple here that would pull out. Norges Bank at the top, one of the largest buyers, although they have been generally moving their portfolio towards the emerging markets, really coming out as one of the biggest buyers of German equities, putting 1.7 billion into the market over the last couple of quarters. That's specifically into German stocks. Capital Research, despite some very substantial redemptions which Capital have been facing, has actually been a very big buyer of German equities. The Qataris, as I mentioned, also continuing to come in, and picking out a couple of other names that we've really seen big buyers of German stocks. T. Rowe, very substantial inflows of new money, and coming in the international fund coming in and buying German stocks. So rather than going all the way through all of the numbers, I would say just to point out the real kind of trends there. One, of course, is the continued trend of the buying by sovereign wealth funds. And then second, actually, is really the number of US buyers that we see coming into the market over the last couple of quarters. So with that, let me hand over to James Fitzsimmons.
Thank you, Chris. So I'm just going to whiz through a few slides talking a little bit about how we would take Chris's data in effect, cut it, splice it, dice it, and then add on our own proprietary information, our intelligence from our traders, from our salespeople, people that we've got on the ground, and come up with tailor-made solutions for you, the investor relations professionals at corporates. I think, though, it's worthwhile just taking a step back for a moment and looking how the top ownership of Dow Jones Stock 600 companies has actually shifted over the last 12 years or so. So the top left-hand quadrant you've got from the year 2000, and you've got a smattering of UK-only funds. There's two Scots in there, together with a couple of German large funds, and obviously with some US investors as well. Fast forward to today, and you have quite a different picture. Only 3 of those funds today were also top 10 holders of the Stock 600 12 years ago. And so what I'm trying to paint a picture of is the universe has gotten very, very global. And I think you, the IR world, need to understand that in instances, you've got to think about your company not just versus your domestic peers or your European peers, but if you are a Roche or a Novartis, how you're thinking about life versus a Pfizer or a Chugai in Japan. I think that's a very, very important message to get across, especially when conversing with US shareholders or potential shareholders. So forgive me, this slide, it's meant to be a sort of smattering of all sorts of different colors, of shapes and sizes. Basically, this was some work that we did with a continental European healthcare company where we took a large amount of data from Thomson, Reuters, and we basically we identified who the key shareholders were, who the key underweights were through an overweight and underweight analysis, broke it down into UK, US, Europe, and the hedge fund community as well. And the pink ones are what we call target investors, and the yellow ones, which doesn't actually show on that key down there, are current shareholders. And then what we've done is basically what we would tend to do is work with the company, very important, to identify those areas and basically the goals of your investor relations strategy. So are you looking to diversify your geographic shareholder base? Are you looking to purely look at service your own shareholders? Maybe that is the most appropriate strategy dependent on where you are in the cycle of your company and where the market is at the moment. And what we would typically do, that is a sort of 40, 50,000 foot level, is then we would take it down and we would talk with you and identify a key area. In this instance, let's talk about the US. And it might be that you see Fidelity 5 or 6 times a year, but are you seeing the right people at Fidelity? There's a separate slide which I wasn't actually allowed to put in here from our own internal people, but it's basically a roadmap of Fidelity. We've basically mapped Fidelity right the way through their organization. We have a wonderful understanding of where pockets of money lie, if you're a value company, where that value money is, et cetera, et cetera. This is making use of our expansive network of salespeople and traders who are talking to these individuals day in, day out, and whom you guys might not know through the general course of your investor relations activity. Also, I think it's really important in that exchange of ideas and talking through the goals that you want to get out of your roadshowing activities, to basically say, look, we targeted this guy, it doesn't make any sense whatsoever, who can we also target there? And that exchange of ideas is absolutely crucial. We can come to you with some snazzy slides, but the real nitty-gritty of basically getting a tailor-made solution for yourselves is that sharing of information. And going back to what Karen Priest was talking about in the keynote speech earlier on, trust is hugely important in this. And as a member of the investment banking community, when she was talking about trust, I was sat there thinking, yes, I can definitely identify with that, and how important trust and building trust is. And I think it's for the vast majority of corporate access teams across investment banks, not everybody, but for the large part, I think it's important to recognize that you, the corporates, are our clients, not these people on this slide. And I think it's important for you to understand that we're actually working on behalf of you. We are taking your senior management time, you're outsourcing it to a third party, i.e. ourselves. And if we abuse that trust, then we might as well not be in this business. And I think it's really important to get that message across. So the biggest thing that I talk about to my team is one of trust and also, importantly, empathy. We need to empathize with you guys. If I was responsible for Lloyd Blankfein, our CEO, or Gary Cohen, our COO's time, they're pretty intimidating characters. I frankly would have lots and lots of sleepless nights. Thankfully, I've never had to do that, but I get it. We get it as a team. We are entrusted with your own CEO and CFOs and COOs time all the time, and we've got to get it right. So what does it mean getting it right? The bread and butter of logistics, all the rest of it, that's just taken and read, but it's basically maximizing yours and your senior management's time. And in many respects, it's trying to provide you with that little bit of extra information, which frankly speaking, makes you guys look smart when you're walking into that meeting, and you can turn to your CEO or CFO and say, this is what this guy will want to talk to you about in this meeting. And it's that level of information that we would hope that we can provide you with, okay? And then finally, final slide just on what US investors are really focused on at the moment. This is talking to a myriad of different people internally and through our own experiences over the past, basically since the beginning of the year. So Europe is at best, and I would say at best, a neutral position for most US asset managers. I think it's really important to think of understanding who your audience is in the US, and I'll come onto that in a minute. I would say many are still overweight, unless you are a staple or a pharma company or a technology company. Those are the key equal or overweight positions that US investors have in the European market at the moment. There's a lot to be done still in a lot of the cyclical sectors. I think they're probably equal to slight, I would still say underweight in actual autos, and quite a few investors are very underweight still in a lot of the cyclical names. Getting towards equal weighting in many of the investment banks or the financial services sector. Thinking on Europe, and this has really just changed in the last 12 months, basically since Draghi's speech back last summer. Thinking in Europe has now shifted back to company first and then country. As you guys know, obviously the DAX for some years now has been the best performing index during the sort of 09, 11, 12 era. It's important for you to understand that now people are looking at things on a micro level again, as opposed to just thinking, okay, where is it safe to invest my money? Let's forget about Spain, let's forget about Italy, let's forget about Portugal, let's forget about Greece. Let's focus on Germany. Okay, which companies in Germany? Now it's a case of, okay, there's some good assets there. Let's look at that particular company. So I think there has been a renewed bifurcation in terms of stock picking. We've seen a breakdown in the correlation between how different sectors move. Before, most sectors tended to be very correlated. I think with the equity risk premium starting to come down, that correlation has actually broken down, which for you, the investor relations professionals, is very important to understand that a lot of the analyst population that you are speaking to is back into stock picking mode. So it's a finite pool of capital. Quite often it's who shouts loudest and most effectively wins that fight for capital. Germany still is the first port of call, however, for exposure to cyclicals, exporters, and potentially weaker euro. I think a lot of people are talking about this whole Japan versus German exporters trade. And I think one of the interesting notes, a lot of people have gone overweight in Japan. Obviously, the last few sessions have seen Japan come back, but a lot of people are just thinking that is more of a blip and profit-taking than anything else. And if people are still thinking about adding more positions to Japan, then arguably they could be taking that away from Europe. Okay. Staples are a very, very crowded trade. I think a lot of people are talking about a lot of the consumer staples names, whether it be a Diageo or a Nestle or whomever, are at multi-year highs, especially at a relative level. However, perhaps over the next 5-10 years, similar to how Coca-Cola was trading at 18 times for the best part of 20 years, that is still to remain. These companies have very high quality management, they have great exposure to fast developing countries, but that is a very crowded trade. If the markets continue to behave as they have been over the past 6 or so months, hopefully you would expect some sort of rotation into cyclicals. That is certainly what US investors are focused on. Interestingly, we've seen that the hedge fund community in the US is a little more, shall we say, wants to wait and see on Europe's ability to actually deliver some sort of GDP growth versus the long-only community. I think the long-only community are quite happy to invest now, and for the longer term, the hedge fund community have kind of had their fingers burnt far too often. So they're still arguably much more underweight in Europe. I think that, and this is something I mentioned before, it's very, very important to think about your messaging on a strategic basis, almost to the extent of you've got a different set of presentations that you're taking with you on roadshow to the US than you have for your roadshowing around Europe. And that's mainly because the vast, or virtually every single person you're talking to is either an international or a global PM. There aren't any European dedicated portfolio managers in the US. I'm speaking to the head of our Boston office. He said, I don't speak to anybody that is dedicated to Europe. And he's a European salesperson himself. So I think that is really important. And I think the other thing for you to understand is it surprises me how seldom we get approached by companies when we've had them on the road to help them understand who it was actually in those meetings. When you go into a large global asset manager and there could be 15 people around the room, very seldomly do we actually get a list of names that we need to go back and do a little bit of homework on to help you understand who those individuals were. Who was that asking about the question about margin compression in the business? And I think that's something that investor relations can do a much better job of. At the end of the day, you're dedicating an hour of your CEO's time to a group of people that may or may not own your stock. The very least they can do is introduce themselves properly and explain a little bit about what they do and where they fit in within the organization. So I think that is something that we're quite surprised that investor relations doesn't do a little bit more. Yeah, please.
Thanks. One question on that. I think sometimes it's unpolite to ask them if there are 15 in the room and 10 on the video screen. If I start asking everybody who he is, it takes 20 minutes.
I think what you can do, and it's a very good question, I thank you, is at the very least get business cards. And I think that before now I've seen people with a blank piece of paper and they're literally positioning the business cards around the page in terms of where they're positioned in the room, and they're writing down the questions what that individual is asking. And then afterwards, then you can go to your friendly broker and say, hey, get the information for me as to who these people are. And then you can probably, and frequently we get IR people coming to us saying, listen, our analyst doesn't quite get it. He seems to be the gatekeeper within that organization. And if you start to get little tidbits of, or a little nuance in some of the questioning from a portfolio manager that runs a 4 billion international discovery fund or something like that, without necessarily bypassing your gatekeeper, you can possibly start to build a relationship with that individual and email them and say, listen, is there anything more that we can help you with, et cetera, et cetera. And I think that is, but I think it has to be done. If you're roadshowing your CEO that is responsible for tens of thousands of people's lives, the very least you can do is ask a bunch of 25, 26-year-olds in the room what they do for a living. I think it's frankly speaking, it's just common courtesy. And unfortunately, it is actually very difficult for us to get that information beforehand. We've tried and we failed on numerous occasions because you all know Fidelity have this internal kind of intercom system, and you can be a portfolio manager sitting at the desk going, I'm bored of working on this model, I'm going to trot along to that meeting. And so literally until that meeting starts, you just don't know who's going to be in the room. But we can definitely help afterwards, and as can many brokers. Corporate governance is very, very important. However, and this is a good thing, I think many German management teams are seeing as being amongst the best in class for that. But it is very important in the eyes of US asset managers. And I think a lot of people, especially here in Germany, are quite still, to an extent, focused on hedge funds and hedge fund activism. We see that as being a pretty loud exception, as opposed to certainly not the norm. I mean, you can all read about Greenlight and Apple and everything else like that, but we feel as though that is very much, they are a noisy group of people that aren't very numerous. But I think it is important to engage with that particular community. But as Chris's information showed, I think, 2.4% that they own. So they're not the most important group of people by any stretch of the imagination. But Apple might think that they are at the moment. You never know. And that's me for the moment.
Great. Thank you, James. Now, let me just finish off by giving you some information around benchmarking of meetings, and this data comes from Thomson Reuters Extel. It's actually the 2013 data, or a very small subset of it, I should say, which is yet to be released. But we're front running, is exactly. So all of the data will be out on Monday next week. But a quick sneak peek into in some of this information. So one of the questions that commonly comes up, of course, is just how many meetings should I be doing? How many meetings is normal? And of course, this can vary and can be benchmarked according to the size of the company, large cap across Europe, vary according to sector, vary according to country, and so forth. But we just thought we would just take the averages across Europe and give you an idea of just how many meetings people are commonly doing. So the chart on the left is when we ask companies how many one-on-one meetings the CEO or CFO does in the course of a year. You can see that the most common response there, like the largest bar, about 40% of respondents are seeing their CEO or CFO doing between 50 and 100 meetings over the course of a year, although a reasonably substantial number, up at 22%, then doing between 100 and 200 over the course of the year. Then on top of this, and this of course should be additive, is then the number of IR meetings, IR-only meetings, where the most common there is 100 to 200 IRO meetings over the course of a year. Then on top of that, of course, the group discussions and roundtables and what get called group one-on-ones, the number of CEO, CFO, and then of course typically, because the IRO is always going to be in the meeting, but CEO-led group discussions, if you like, most common to do somewhere up to 50 C-suite over the course of the year, and then investor relations also commonly doing up to 50, but then with a pretty substantial number, almost a quarter, then doing between 50 and 100 meetings over the course of a year. Now, one of the other topics which has become hugely important, of course, over the past couple of years has been broker conferences, and I think we've all seen the extraordinary rise in the number of broker conferences that have been organised, partly in response to increasing appetite among the buy side to meet with and to hear from companies, but also partly because Many members of the buy side can't travel as much as they can do. Their travel budgets having been cut back, and so of course a broker conference is an incredibly efficient way of both sides of the community, that is the issuer and the buy side, getting together and conducting a lot of meetings in a very short space of time. But of course that growth in the number of conferences has led to many questions about, well, just how many should I be doing? How many is normal? Are there some that I should be cutting back on in some instances? So we asked companies in much more detail about the number of broker conferences that they're doing. The chart on the left-hand side is the C-suite involvement, the CEO, CFO at a broker conference. See, the most common there is between 3 and 5 in the course of a year. Investor relations also shouldering more of the burden, if you like, of doing broker conferences. Again, the most common there is for them to do between 3 and 5 broker conferences in the course of a year, although over a quarter of them are doing between 6 and 9. And then, interestingly, the number of times in which regional directors or divisional directors are actually getting involved in conferences. It's not as common as we see in their involvement in, say, analyst days, but it is interesting that you've got a bit over a third of companies are involving a regional or a divisional manager in at least 1 or 2 broker conferences each year. And then lastly, just to finish off with some of the roadshow destinations, we take this data according to a large number of destinations. Both this is at the top, US East Coast, but we also look at US West Coast and so forth. So what you can see from this is that this is German IR teams who are visiting the East Coast. Around half of teams are going to the East Coast 3 or more times every year. That was actually an increase compared to last year, so actually seeing German investor relations teams traveling there even more frequently. It's much more common than going to the West Coast. Typically that's around once or twice per year. Chart on the bottom left around roadshows to the UK, of course, very, very common destination. Most companies, or virtually all companies, going at least 3 or more times. And interestingly, and again an area where we get asked a lot, and that is about the roadshows to Asia. So this chart in the bottom right-hand side, you've got a situation here where now over half of companies are going to Asia at least once. Only a small number, of course, are going on multiple trips, but you've got a third of companies going just once, and then, of course, others going twice, 3 times, or even more. We've seen this steadily grow over the last couple of years. Not rapidly, I would say, but just slowly. That frequency with which companies are going to Asia is steadily ticking up. One of the other pieces of analysis which I think is very interesting is to look at the practice of the best investor relations teams and to look at what it is that they are doing and how that compares against the average. One of the things which the Extel team have done for several years is to take the best IR teams as voted for by the buy side and the sell side, and to examine the practices of those top 10 teams to see how they vary compared to the norms. Interestingly, of course, that top 10 group of investor relations teams is very, very heavily represented with German IR teams. So consistently now we're seeing German IR teams coming, dominating, I would say, the best practice and the top of the Extel rankings. So a couple of the things which those top teams are doing sort of more frequently when it comes to the broker meetings, the number of one-on-one meetings, they are consistently doing a lot more one-on-one meetings, both with the CEO, so they're consistently up at the sort of the 200 to 300 and 300 plus area in terms of one-on-one meetings. The IROs consistently doing more one-on-one meetings. They are participating in more group discussions than the average. They are road showing to the US more frequently. But there's a couple of other things as well which I think sets them out, which is critical to note. They tend to be more strategic in their outlook. They view strategy as being a really important part of the investor relations program. They're much more interested in activities which are really at the cutting edge of investor relations. So, for example, social media, socially responsible investing, much more likely to take that as part of their overall IR activities. So let me just quickly wrap up and then open it up to questions for James and to me. So just to run through some of the important parts of constructing an investor relations targeting program. Critical to start off with understanding your current shareholder base, how it compares to your peers, in order to understand really what your strategy should be, where it is that you want to get it to. Make sure that you have real communication with both your internal and your external stakeholders so that people really understand why it is that you're conducting your IR program, so that your management understands what the demands are of their time, why you are taking them to these places, why you're taking them away from running the business and the importance of getting out and seeing these shareholders, and also having that dialogue with the other providers such as corporate access teams so that they too understand what your objectives are. Bringing it down to a very target, a very focused list of investors. There are a huge number of investors out there. You really need a way of screening it through, understanding who is really going to be able to buy into your stock, who's interested in both your sector, who's comfortable with investing in Germany, and critically then getting into some of those global funds where finding the right person is not always easy, and making sure that you understand that there can be multiple touch points within that organization and trying to construct a map of who it is that you are actually speaking with or who you should be speaking with. And lastly, really measuring the effectiveness of your IR outreach efforts. There's no point using all of this time and money and just going out and just conducting all of these meetings without then taking a step back at the end of it and really looking at how effective you were in hitting your objectives. So with that, let me please open it up. I'll come back and join James, and if you've got any questions, please fire away.
Yes, there was an article in today's FT talking about the level of investor meetings, one-on-ones with hedge funds versus other long investors, and it being very heavily weighted towards hedge funds, as taking up the lion's share of management's time, and it linked the high pay commissions that hedge funds are willing to pay to corporate access teams for access to management's time. So do you have a comment in terms of how the issuers can manage that process so that they are getting the types of investors you mentioned and Chris talked about before to get the best mix and not only getting perhaps those activists or short-term?
Absolutely. I think I'll take this one. Great question. It's a subject that is hugely front of mind at the moment. I didn't realize the FT had published another article this morning. They obviously have. There's a few things, and I'm not necessarily talking about it from a Goldman Sachs perspective. I'm talking about it from a sell-side industry perspective because I have had conversations with my counterparts through the AFME sell-side body and everything else like that over the course of the past 6 months. It was one of my competitors that had actually done an analysis, and we looked at it ourselves, and we can pretty much, the numbers are exactly the same almost. And that is that the top 20 paying institutions across the board for each of our businesses, 90% of them were long-only funds. Okay. I think it is a fair misrepresentation in the press about the sheer number of meetings that do get sent to hedge funds. I'm not going to say that if you look at the hedge fund assets under management on a globalized basis, around about 5% at the moment. And Chris mentioned it was like 2.5, 2.4, 2.5% for Germany. I'm not suggesting for 1 second that we only allocate 5% of all meetings to hedge funds. That's not the case. But I think that there is quite a big disconnect between what people understand as being common practice, and that is based around the whole kind of charging aspect. We as a team, and I can safely say this across most of, if not all, the people I've spoken to across the sell side, we have no facility whatsoever at the moment in order to actually physically charge anybody anything. I cannot raise an invoice. If we were to take a company on the road and then they say, listen, can you just pay for that hotel and bill us? We tried it once. It took 6 months. 6 months for actually to figure out which division can actually physically raise an invoice. It was ridiculous. So I think some people think that we have a little podium on our trading floor which the analysts come down and they stand at and all the rest of it. I think some people think that I get up there at 10 o'clock on a sort of Tuesday morning and auction off CEO time to the highest bidder. I mean, it's absolutely ludicrous. I think the biggest thing I could say, and I can say this safely about myself and my team, is that we don't do a thing, not one thing, until we've had 100% buy-in and okay from the investor relations professional. I cannot vouch for that across the entire sell side, but whether that be for a roadshow or for conferences. Ahead of a conference, we will send the list of meetings that we have set up together with who is on the wait list, because quite often supply or demand outweighs supply. And that list is sent to the corporate way ahead of the ultimate list being sent to the investors, precisely so that there can be an exchange and dialogue with the case of, well, I don't want to see that guy because of whatever reason. I saw him last week or whatever at somebody else's conference or a roadshow. This guy hates us, and he just antagonized my management. And we have a discussion and we take people out, we put other people in. And then once the investor relations team is 100% happy with it, that's when it gets sent to those investors. So I think that if IR teams are frustrated by the amount of hedge funds that they're meeting with, I think there's a few things. One, you can easily say no. Secondly, if you do go to a place like, for example, New York, there are a lot of hedge funds in New York, has to be said. Thirdly, I think there's still a huge amount of ill education around the hedge fund community. I guarantee you, I think there's only been one long-only buy-side institution that has categorically said that they will not set up an internal hedge fund, and that's Capital. The vast majority of people that you are meeting across the City of London, especially, that are long only, somebody in that room will be running an internal hedge fund. Guarantee it. Whether it's a Henderson or BlackRock or a Schroders or a Threadneedle, all run hedge funds. Sometimes I think it's better for you to understand, if you're going to see a Citadel or an Oxif or an SAC, to actually understand they are a hedge fund. Whereas, going back to my earlier example, if you've got 15 people, it's kind of, which one of you is the hedge fund manager? Or which 2 or 3 of you are the hedge fund managers in this room? So I think there is quite a lot of misrepresentation out there. But it's a great question. Thank you very much for giving me the opportunity.
And I would just add very quickly to that I think it shows the need for investor relations to be proactive and to really engage and to understand if someone is proposing a roadshow, then who exactly are these investors, and making sure that their management time is getting allocated in the way in which they think aligns best with their own interests, and not being just led around blindly and seeing whoever it is that the broker may propose.
2 questions, if I may. One of your key takeaways was measuring the effectiveness of the meetings. any suggestions how you do that? And second point on, do you have any intelligence on your survey concerning the distribution between existing shareholders and targets in terms of management time and IRO time?
Sure. So let me try and take both of those. First of all, on measuring effectiveness. It's a really interesting topic because, of course, in investor relations, since it's a role of an influencer, how do you measure how effective you've been as an influencer when you can't actually make outcomes happen? A couple of the things that we think about in which we can present that data. First of all, is simply to look at the objectives that were set up and then what the actual outcome was. So in other words, if the objective that was set up was that you were going to hold 200 one-on-ones over the course of the year, it was going to be split in a particular way between CEO, CFO meetings, IRO-only meetings, group meetings, and so forth. Then at the end of the year, how many meetings actually did you take place, and did you manage to align the top investors with meeting the CEO, less important investors with meeting in group meetings, and so forth? And of course, there's always going to be a little bit of variation one way or another, but what's interesting to look at investor relations programs is actually how often there can be a misalignment, that investors who really don't deserve to be meeting the CEO one-on-one can grab the CEO's time, and an investor that was really substantial and could take a large position who have ended up in a group one-on-one, for example. So it's just, first of all, making sure that activity was actually aligned with your interests. Then, of course, there's looking at, well, what was the outcome? Did your targets, did they buy? Or if they were current shareholders that you wanted to make sure that you kept on board, did they sell? And I think it then needs to go beyond that, because of course, we can't make people buy or sell the shares, but at least to gather a little bit more intelligence about, well, if this was a top target and they didn't buy shares in your company, what did they do? Did they invest in one of your peers, for example? Or did they just not invest in the sector at all? Did they actually rotate out of the sector? Which, if they rotated out of the sector or they didn't invest anywhere in the sector, I think that would give you more comfort that it wasn't stock-specific issues. It was more a general portfolio rotation issue, which led to them not buying into the stock. I think then lastly, just looking at that level of benchmarking the activity and how you compare against your peers can give you a good idea of just are you keeping up with common levels of activity in the sector, and how good are your outcomes compared to your peers. The second question about the allocation of time, yes, Thomson Reuters Extel does collect that data about how much time is actually allocated to current shareholders, to prospective shareholders, to former shareholders who have used to own the stock but have now sold out. One of the things that I think is really interesting, I was talking about what top IR teams do and how they allocate their time consistently. Top investor relations teams in Europe are spending more time with prospective shareholders and relatively less time with their current shareholders. So in other words, they're really taking the view that your current shareholders, sure, you've got to see them, they are seeing them, but they get it, they believe the story, they're believers in you. So you don't need to spend so much time with them. What you do need to do is spend more time out there with prospective shareholders. And interestingly, those top teams also spend relatively more time with former shareholders. They don't just say, okay, you've sold shares in our stock, we're never going to speak to you again. They're keeping up that dialogue with people who used to own and ultimately trying to convince them to come back into the story. and that is something where, unless of course they've had a particularly bad experience, it can be very, very fruitful to find former shareholders and persuading them to buy back in.
I come back to another question on the corporate access side. The Financial Times is discussing just the corner of a much, much bigger issue. James, if you had a crystal ball and you looked into the business model of corporate access in the future, do you think there will come a point when brokers may actually have to charge corporates, given the fact that the regulatory authorities in the UK are looking into the business model and trying to understand why fund managers are paying to see the companies they invest in? And at the same time, from the IROs I've spoken to, they like the business model because they don't have to pay for the roadshow. Do you think there will come a point when the model may have to change and actually brokers might charge corporates?
Fred, this is something we can presumably later on take offline and have a debate about. But I think all I'd say at the moment is that we've been obviously very engaged and focused on this issue. I must clarify that we have not been able to have a direct conversation with the regulator ourselves, but the sell-side body had one before Christmas. I run the business in Europe, and there is a lady, a partner managing director at Goldman Sachs, who runs the business globally, and she spent a lot of time on this issue as well because it's starting to get quite global. We are both in agreement that nothing in terms of our business model or our strategy from the provision of the, shall we say, the supply of corporate access is changing in the foreseeable future. We've had no discussion surrounding charging corporates. There has been a suggestion by some investors that they may feel the need to be charged themselves because of incentivization issues. We don't feel as though that is the right thing to do. For the reasons that I mentioned beforehand, we are often, in vast majorities of the time, if we have to get the ultimate sign-off from an investor relations professional in terms of who we are putting their management in front of or themselves in front of, you could argue that we, and I'm no lawyer on this issue, that we are acting on behalf of the company. So I don't know. My crystal ball's looking a little murky at the moment. We're working through it. We're very, very focused on it. But I think there is still quite a lot of issues to work through.
Thank you for being so frank in the answer, because it's a very difficult issue, certainly in London, as a discussion at the moment. And UK IROs are pushing back and saying they like the business model, they don't want to pay for a roadshow, so for them it seems to work.
Yes. I mean, there's can have a debate offline without the camera.
Any other questions?
If you were to define an IR strategy for a small cap, a non-index company, 100 million in market cap, maybe from Germany, to attract US investors, what would your advice be? Because they usually don't have a big broker in order to get the access to investors, but what would your approach be?
I think that depending on the company, depending on the sector, there are actually, and I'm not advocating completely using competition, but it's very much horses for courses. We work with a myriad of different companies in terms of shapes and sizes and sectors. Some we feel as though we can do a good job on. Others, for example, if we don't have research coverage, it becomes very difficult for us. I think that dependent on a company and its life cycle, there is definitely a case for consultancies to be used. The biotech industry is a great example. I think the biotech industry in Germany was once a little bigger than it is today, but there are consultancies out there that very much dedicated to US investors, and I've worked, because I cover the healthcare sector together with the chemical sector as part of the team, and we've kind of pushed people in that direction with pretty good results. So I think it is quite often worth spending a little bit of extra money or that portion of your IR budget on something like that, because frankly speaking, sometimes with bigger brokers, you can get lost in the noise in the ether. Where there are a finite amount of people, a finite amount of hours in the day, and we can't necessarily, and this is always subject for discussion, offer completely the same level of service to absolutely everybody. So I think that in that instance, outside help can be of great value.
And I would just add to that I think that it's also very important to do the background research, because there are a number of funds that focus on small and mid-cap companies. Clearly, it requires more work to identify them, but you can we do work with helping companies to identify who those funds are, either because it's their mandate, they're very clearly mandated towards small and mid-cap, or sometimes just looking at the buying patterns and seeing that this particular fund is buying into companies with certain market cap thresholds, and also sometimes looking at funds where there's a real interest in a particular sector, and they have a particular sector expertise. And although you may be at the low end of their market cap range, if they really like that sector, then they may have a higher level of interest in, certainly at least with meeting with you.
Chris, you mentioned Asia, that Asia is becoming more important as a destination for investor targeting. And the question is, what's your outlook here? Because I think among the companies who have done more targeting there, more roadshows there has been some frustration about sort of lack of flows of funds coming back. So there was basically no investment, and CFOs kept asking, why should I go there if there's no real investment activity?
Yes, no, it's a very good question. Yes, and one that we do get asked. Is it actually worthwhile going? And you can see from the chart that I put up that of the companies that do go to Asia, that most commonly they're going once per year. But actually, what we see is that going once per year bears all of the costs of the trip, but actually delivers very, very little in terms of actual new buyers in most cases. So a couple of things which are I think are very, very important based on our data, what we see of actually companies that are able to increase their ownership by Asian institutions. First of all, it's very, very important to have exposure to the region. You actually got to have assets on the ground in the region, so that you're part of a story. There's an Asian investment story. Very, very little interest in companies that are just purely domestically focused in particularly in Germany or anywhere in Europe. So got to be global companies, got to have physical footprint on the ground in Asia. Management have got to be out in Asia on a frequent basis, at least to run the business, preferably to have board meetings and so forth in the region. And so you can actually tie investor meetings on top of that. And it's got to be a frequent dialogue, really, I would say two trips per year, and then following up with video conferences and other broker conferences and calls. And also, Asian investors they do have very long holding periods. Once they buy in, they tend to buy in really for the long term. But of course, the flip side of that is that the length of time they take before they take a position is also very long. So companies that just go over to Asia, do one roadshow, see 6 countries in 5 days, incredibly jet lagged, not really sure where they are, come back to Europe and expect to see an increase in ownership is just not going to happen.
I think from our side, we've seen a huge take up in or amount of questions from corporates in terms of asking about the region. And I think that there's a few things I would say. Number one, don't think of Asia as being Asia, or rather, don't think of Asia as the region. There are different cities in Asia need to be treated in completely different ways. And that becomes very difficult from a perspective of you are kind of flying down there, you are investing time and money as well. I think, so for example, and this really does depend on what type of company you are and which sector. For example, if you are a healthcare company, going down to Singapore is a very good and important thing to do. Singapore is fast becoming, for many companies and many sectors, the sort of Boston of Asia. There are pockets of money, there's portfolio managers based at global institutions that all invest in that. Similar for a number of other sectors, but I think Hong Kong, apart from one or two meetings, is kind of almost a waste of time. Japan, you'll have a day and a half of very high quality, very good meetings, and they'll be incredibly appreciative, but I think there are different dynamics there. Beijing, again, is pretty much one investor. So I think a lot of it is managing expectations. And frequently we have the conversation with the company in terms of, listen, this is my management wanting to tick the box, how can you help me? And we both understand that this, as Chris said, this can be a sort of long-term investment of time and money. Other companies are quite willing to take our lead and basically understand that there's no point in spending a full day in Hong Kong. Just jet in there for a breakfast and a couple of other meetings. So there's very much this whole quality versus quantity of meeting trade-off. And so it is a very, very different place to roadshow. And I think in those instances, you need to properly be aware of it. And we can help you convey a different message to your senior management if you need to, but I think it's important that the investor relations professional plus the corporate access team is kind of completely on the same page in managing expectations.
Great. I think we may be up against the time. So thank you all very much for your time today.
Thank you.